Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on July 24, 2026. We're Elena and Marcus, and happy to be back after a week off.
Yeah, it is really good to be back, Marcus. And look, if you are looking at your portfolio right now, you are probably feeling a severe case of whiplash.
You absolutely are, because we have this bizarre dynamic today where the fundamental economic engine is actually humming perfectly, but the steering wheel of the market has, well, it has temporarily been handed over to algorithmic robots.
Right. The surface level price action is completely detached from the structural data. So let us begin by establishing the current macroeconomic regime using our internal quantitative framework.
Because when you evaluate the market on any given day, Elena, it is just incredibly easy to get overwhelmed by the static.
Exactly. You have daily earnings beats, random geopolitical headlines, endless central bank commentary. And to cut through all of that noise, we rely on the OCM PCA model.
Right. And for anyone listening who might not be running their own quantitative models, PCA stands for Principal Component Analysis.
Which sounds incredibly dense, but it is actually a highly intuitive concept.
It is. I like to think of PCA as an advanced audio equalizer for the financial markets. If you are listening to a really complex piece of music, there is a lot of high-frequency treble.
And in this analogy, that treble is the daily financial news, right? The minor data revisions, a CEO's tweet the noise.
Exactly. The PCA equalizer filters out all of that high-frequency daily static to isolate the deep underlying base track. That base track represents the primary macroeconomic factors that are actually driving asset prices over the long term.
I think that is a perfect way to visualize it, Marcus. And the outputs from the OCM PCA model this week are incredibly clear. That base track firmly anchors our environment in a normal or reflationary state.
Starting with PC1, our primary global growth factor.
Right. PC1 continues this steady upward trajectory. It currently sits at the 84.1st percentile, which tells us we are seeing positive, non-extreme growth momentum across the global economy.
And concurrently, you have our rates and reflation factor, that is PC2, registering a highly positive 5-year rolling baseline.
Yeah, and that reflationary component is being heavily driven by rising core global 10-year yields, alongside exceptionally robust performance in the copper market.
Let us add one more layer to that, Elena. Our proprietary modeling also tracks a tertiary macro factor, PC3.
Which usually just operates quietly in the background, tracking tail risks.
Right. But we have observed an aggressive flattening and stabilization of its negative score over the last 14 days.
So in plain English, the underlying structural risks within the global macro environment are rapidly stabilizing.
Exactly. The baseline quantitative state suggests a highly supportive, fundamentally sound environment for risk assets.
Which is the structural reality of the data.
But I have to push back on how that actually feels in practice, Elena. Because if the underlying growth engine is humming as smoothly as the OCM PCA model indicates, you really have to ask why the dashboard looks so erratic to everyday investors.
It is a fair question.
We have experienced this highly volatile, choppy trading range for 2 months. If growth is fundamentally stable, why does the surface level of the market feel so incredibly fragile?
Well, that is the critical tension our proprietary modeling is flagging right now. The OCM PCA model detects a structural disagreement between time horizons.
A disagreement in the look-back periods.
Exactly. When we utilize a 5-year baseline, the model categorizes current global growth as normal. However, when we apply a Tiger 3-year window, the model triggers an explicit disagreement flag. It recategorizes recent growth as euphoria.
Meaning the momentum driving our recent growth is mathematically stretched relative to post-2023 norms.
Right. You have a fundamentally strong economic foundation. The base is totally solid, but the velocity of that growth over the medium term has become extended.
And when momentum outpaces the structural foundation, it creates that surface-level fragility you are observing in your portfolio today.
Precisely. Because the fundamental engine remains robust, the choppy market range we have experienced recently is entirely a product of positioning and flows.
It is a matter of who is sitting behind the wheel of the market at this specific moment.
Yeah, and to understand this dynamic, we have to look at the contrasting behaviors of discretionary human investors versus systematic algorithmic strategies.
And market intelligence indicates a massive divergence there. Discretionary human investors have become visibly spooked.
They absolutely have. The consensus across the street shows that discretionary funds have sharply cut their equity exposure. They drove it down to the lowest levels we have recorded since early April.
They are taking risk completely off the table. And we are seeing parallel defensive behavior from retail investors, too.
Right, retail flow data demonstrates a broad-based pullback. Flows into technology sector ETFs officially turned negative for the first time in months.
And here's the catch, while human drivers are stepping on the brakes, systematic strategies are not.
No, they are maintaining exceedingly high equity exposure, specifically commodity trading advisors, or CTAs.
We should really demystify how these systematic traders operate, Elena, because they are currently driving the bus. You can essentially think of systematic traders as algorithm-driven surfers.
That is exactly what they are.
If you consider a human surfer, before they get into the ocean, they might analyze the water temperature, they study the weather patterns, review the tide reports.
Which, in financial terms, is fundamental analysis, reading balance sheets, analyzing corporate earnings.
Right. But algorithmic surfers do not care about the fundamentals. They do not look at the sky or the water temperature at all. They only care about the momentum of the wave.
If an asset's price is going up, the algorithm is mathematically programmed to buy it. Period.
And if the price drops below a certain moving average, the algorithm automatically sells it. It is entirely devoid of emotion.
And right now, market intelligence confirms these systematic surfers are heavily overweight in equities, particularly in the United States and European markets.
And they also hold elevated long positions in the trade-weighted dollar. And they are highly long industrial metals like copper and energy markets like oil.
Which creates a highly specific structural risk for the coming days, Marcus.
It does. If the equity market drops meaningfully, and our modeling suggests a threshold of just a 3% decline from current levels, these algorithms will be mechanically forced to hit the sell button.
Right, just to reduce their risk exposure.
And that is the danger of mechanical selling. If that 3% threshold is breached, the algorithms do not pause to consider if corporate earnings are actually strong. They just execute the sell order.
Which introduces significant downside supply into the market, accelerating a slide precisely at a moment when retail and discretionary buyers have already stepped back.
Which brings us to the macroeconomic and policy backdrop, because we have to ask, what specific catalysts could serve as the match to light that fire? What triggers the algorithms to begin selling?
Well, next week presents a massive slate of macroeconomic data that fundamentally dictates the cost of money. We face the Federal Open Market Committee meeting, United States PCE inflation data, and second quarter GDP figures.
And for our listeners, PCE stands for Personal Consumption Expenditures. It is the specific inflation gauge that the Federal Reserve prefers to watch when deciding whether to hold or cut interest rates.
Right. And overseas, we also have the Bank of Japan policy decision and Eurozone CPI data. So this is a total gauntlet of major liquidity events packed into a few days.
And these macroeconomic shifts directly dictate everyday liquidity. However, the prevailing narrative is acting as a heavy wet blanket on market sentiment right now.
It really is. The consensus across the street is hyper-focused on geopolitical escalations in the Middle East, climbing oil prices, and the prospect of higher rates for a longer duration.
This anxious macro backdrop is completely overshadowing what corporate fundamentals are actually doing, because the second quarter earnings reporting season is currently confirming that the corporate profit boom is actually accelerating.
Companies are making more money, yet the dominant narrative remains totally fixated on surging technology capital expenditures.
And this anxious environment has significantly shifted capital flows beneath the surface. We are observing defensive spending themes and copper-catching aggressive bids from investors seeking tangible assets.
Geopolitical hedges, essentially.
Right. Conversely, the hyperscalers, those massive cloud computing and technology companies building out data centers, along with artificial intelligence software themes, they are underperforming.
Because the street is deeply worried about the long-term return on investment for these massive AI infrastructure build-outs.
Exactly. So with these major macroeconomic events looming and capital flows shifting defensively, you have to look under the hood at the market's internal plumbing.
Right, to understand how Wall Street will actually absorb the upcoming volatility.
And the critical component of this plumbing is dealer gamma. Elena, let us demystify what dealer gamma means for a regular portfolio without getting into abstract options mathematics.
Sure. You can basically view Wall Street options dealers as the market's internal suspension system.
I like that.
These dealers act as massive middlemen. They facilitate options trades for institutions and retail clients, but they do not want to take directional bets on whether the market goes up or down.
So to neutralize their own risk, they dynamically hedge their books by buying and selling the underlying stocks.
Precisely. Now, when dealers are in a state called long gamma, the market suspension system is working perfectly. In this state, dealers act as shock absorbers.
Meaning when the stock market dips, their internal risk models force them to buy stocks. And when the market rises, they are forced to sell stocks.
Exactly. This continuous countertrend hedging forces the market to stay calm and range-bound. It smooths out the ride.
Conversely, when dealers fall into a state of short gamma, the suspension system is broken. Instead of acting as shock absorbers, dealers become amplifiers of volatility.
Because if the market begins to fall, a short gamma position forces dealers to sell into that falling market to protect their own books.
And that mechanical selling compounds the downward pressure and speeds up the crash.
Right. Now, market intelligence models currently map dealer positioning as long gamma to the top side, but possessing much shorter gamma to the downside.
So if you are managing a standard retirement portfolio, this structural setup dictates the exact shape of next week's potential price action.
It does. If the market rallies on the back of strong macroeconomic data, that rally will likely be a slow, grinding climb because dealers are continuously selling into the strength to hedge their long gamma positions.
But if the market drops on a bad inflation print or hawkish central bank rhetoric, the transition into short gamma territory means the floor could fall out quickly.
Dealers would be forced to sell rapidly alongside those algorithmic systematic traders we discussed earlier,
Creating a compounding loop of mechanical supply. And we also have to factor retail options trading into this plumbing equation because retail volume remains at extreme highs.
particularly regarding call options on large cap technology stocks.
Right, and this constant heavy retail speculation forces dealers to continuously adjust their hedges intraday, which further stresses an already fragile market suspension system.
So, given a sturdy underlying growth engine flagged by the OCM PCA model, nervous human investors stepping back, and a market suspension system that could fail violently to the downside, we have to identify the primary risk zone.
What we call the pain trade. The specific scenario where the vast majority of the investing crowd gets caught off guard and incurs sudden losses.
Well, the consensus across the street is currently obsessing over individual hyperscaler earnings reports and AI capital expenditure budgets.
They assume the primary risk to the market is a major technology earnings miss.
But our external intelligence indicates the real pain trade is something entirely different. It is a factor flash crash in momentum.
Which makes sense. The momentum factor trade is exactly what it sounds like. It is the simple quantitative strategy of buying the assets that have recently gone up the most and selling what has gone down.
And that trade became exceedingly crowded earlier this year. It reached the 99th percentile of historical positioning.
Everyone was on the exact same side of the boat.
Exactly. And that crowded trade is now unwinding violently. The current unwind features repeated, extreme negative sigma drops.
And for context, a standard deviation, or sigma, measures how far an event deviates from the statistical average. A 1 or 2 sigma move is normal market behavior.
But a 6 sigma move is a mathematical rarity that is technically only supposed to happen once in a lifetime.
Yet we witnessed a massive 6 sigma negative event in the momentum factor just last week.
Right. And when a crowded factor unwinds with that kind of velocity, it forces indiscriminate selling across the board, entirely regardless of an individual company's fundamental earnings quality.
A high-quality company gets sold off simply because it was caught in the momentum factor basket that the algorithms are liquidating.
Exactly. Even corporate credit markets, which are usually immune to equity factor noise, can feel the ripple effects.
Though it is worth noting that credit spreads across both investment grade and high yield remain exceptionally tight. We are not seeing distress in CCC or BB corporate debt.
Which further validates our model's view that the underlying economic foundation is sound.
So, given all this complexity, how should an individual investor actually navigate this environment next week?
Well, the OCM model relies on historical 4-week base rates to dictate our portfolio posture.
And this data specifically directs us to look past the immediate plumbing noise, past the gamma levels and the algorithmic triggers, and focus on the primary macroeconomic regime.
Because our PCM model confirms a normal reflation state, the mathematics recommend maintaining a pro-risk, cyclically tilted portfolio.
Specifically, our proprietary modeling suggests overweighting global equities.
Right. The historical base rates for a normal PC1 growth state yield historically positive forward expected returns for both the MSCI World Index and emerging markets over a 4-week horizon.
And within that broader equity allocation, the fundamental data strongly favors cyclical sectors, companies that benefit from economic growth over defensive sectors like utilities or consumer staples.
Furthermore, the regime heavily favors large-cap equities over small caps.
Right, because historical data within the OCM-PCA model shows that small caps lag significantly during this specific combination of mature growth and reflation.
You want to be positioned in the larger, highly capitalized names that can weather the algorithmic volatility.
Absolutely. And Elena, I want to leave everyone with a final thought to consider as we head into next week's heavy macroeconomic data slate.
Okay, let us hear it.
Currently, the entire street is aggressively buying put spreads and hedging for a downside shock. This is being driven by fears of technology, capital expenditures, and geopolitical tension.
Everyone is bracing for impact.
Right. But consider the mechanics of the pain trade we just discussed. If everyone is already positioned for a crash, and the macroeconomic data, the FOMC decision, the Q2 GDP, the PCE inflation prints, if all of that comes in perfectly benign next week, what actually happens?
All of those bearish hedges will expire worthless or be aggressively unwound by the dealers.
Exactly. The ultimate pain trade might not be a crash at all. It could be a violent melt-up, forcing the algorithmic surfers and the underpositioned discretionary funds to rapidly buy back into the market at much higher prices just to catch up to the benchmark.
That is the asymmetric risk the prevailing narrative is currently ignoring.
See you next week, wherever the flows take us.